Okay traders, welcome back. In this tutorial we are going to speak about the momentum in the candlesticks and how to enter those 4-hour long bearish or bullish candles, because there are multiple ways of doing it. Okay, you can move down to the lower time frames, or you can basically just trade it on the 4-hour, as pretty much as I just showed you. So what you'd basically do is you'd wait for this close, wait for the wick to form, and then as price passes the wick of the previous low, okay, the chances are very high that it's going to continue down, because what it's done is it's created a high. So this is kind of like a liquidity grab, and then once it turns bearish inside this wick area here, all right, what will generally happen is it will follow through, and it will either follow through very quick, okay, so it will just slam down and then pull back, or it will move a little bit slower and, you know, take a bit more time. It all depends on whether you trade in this in high periods of the market where there's high volume or where there's low volume. Okay, so anyway, if you imagine and remember what we're looking at here, so we're looking at what's on the inside of the candle body. We're also monitoring what's happened with the wicks in terms of a liquidity grab or a pullback or the creation of a wick before price continues down. All right, so if you look at that in terms of 30-minute candles, okay, what you normally get is you'll get the closure below a level, okay, and then what tends to happen is you may get what would be a bullish close, okay, but what we need to pay attention to is not the fact that this is now a potential reversal. In some cases it would be a reversal, but we'll go through that in the next video. What we're looking for is to find and to enter on the momentum of this next 4-hour candle. So ideally the 6 to 10 candle, or maybe the 2 till 6 candle, because those are the periods of the day in the UK where there's heavy volume in the market. We want to catch those impulsive moves, get in, get out of the market as quick as possible. So in terms of this area here, if you imagine that this is now the top wick, okay, so that green candle is basically created the wick to the upside, okay, so this is like a liquidity grab, okay, and then it may close bullish. But what I want to pay attention more to, you know, the lower wick on the 4-hour candle here, all right, because what tends to happen is once we've got this move up, and then we may get a little wick here, right, we're marking off these lower wicks here, because this is basically the wick of the previous 4-hour candle, right? So if we pay attention to what's going on here and look to enter on the break of this low, what's basically happening is the market is making a high, making a low, making a higher high, lower high, high high, and so on and so forth. So your entry point, in order to catch this breakout, if you like, and to catch the momentum in the market that you're expecting during these high volume periods, you know, London open, New York open, etc., is that once we form this high, okay, we've got to anticipate the market's next move, okay? So we may get this move here, and then we've got a wick created, and the next candle opens up, maybe forms a little wick. As long as this wick here respects this previous wick on the 30-minute, so we want the candle to open, okay, like this, pull up, we want it to respect the previous wick, and then move down, trigger is in at this point here, okay, which would be our entry, and then continue down on the 4-hour all the way to take profit. However, that may take 30, an hour, maybe 2 hours. Sometimes it can happen in 30-minute candle, sometimes it can happen in 3 candles, sometimes it's, you know, 4 candles, 5 candles before we hit a take profit. But if you've got this entry right and you study it and you watch what happens in terms of when the market pulls back is not to see it as a reversal, is to see it as for what it is. Basically, it's the market creating a wick on each candle. So it moves up, moves down, moves up, moves down, moves up, moves down. Lower time frame, 5 minute, 15 minute, it's more choppy. 30-minute time frame, 1 hour time frame, 4 hour time frame tend to be a lot smoother and a lot easier to predict. So we pay attention to this. Okay, we're looking at this area here. Okay, this is the 4 hour close, and maybe let's say this is the 6 a.m. open of the first 4 hour candle that's going to be traded during London. Wait for the wick. Maybe this will be 2 30-minute candles, right? Don't worry about it too much. What we're looking to do is we're trying to catch the momentum as it blows through. Okay, so we mark off these wicks maybe with a horizontal ray, or anything you want. You can put a little zone there. You can mark the candle wicks as they stand there. And what we want to do is we want to go a few pips below the candle, because we need to remember that there are spreads with the majority of brokers. They've got spreads that fluctuate. We don't want to get tagged in too soon, because there is a very small chance that we can just get wicked in, and then price does actually reverse, and then we're going to hit our stop loss. So we want to go a few pips below. All right, and you may go 1, 2, 3 pips. Take a look at what your spread is, whatever broker you're using, and just add the spread to the order. Okay, when price blows through, it may come back up and tap your entry a couple of times, but what you need to do from there on is you need to pay attention on the 30-minute time frame. And I can't stress this enough. It needs to be the 30-minute time frame and above, and monitor the wicks. Okay, so each candle will have a wick, another wick, another wick, another wick. Now, the only reason that you would need to close this order is if one of the wicks comes past the previous high of the previous candle wick. Okay, so if this happens, there is a chance that it may continue and it's just pulled back for a little bit of liquidity. But if this happens, it's a very, very good idea to close the trade, because what happens is when we've got like a wick to the downside, followed by a wick that doesn't pass the low, and then the next wick goes up above, which I'll go through in more detail in the next video, that is potentially a reversal. Okay, so we want to enter on the break of the wicks. Okay, so again, we're imagining now that this is the 4 hour close, and we want to see the pullback, which is like a mini liquidity grab, and we want to see price action passing the wick here, where we get tagged in, and then the momentum of the short continues through in a high period of high volume and takes us all the way to take profit. So we got the 4 hour close. So this is a 4 hour candle, and then I've broken it down into 30-minute candles here. We got the pullback, or the creation of support underneath the zone. So this would be a 4 hour zone. Once we've got the support created, and again, this may well be a bearish candle. It doesn't matter if it's green or red. What we're looking for is this high, this wick to be formed, right? So that's the wick area here on the 4 hour. Let's just move that up a bit. Okay, so we got the wick created, and then we're paying attention here, right? Once price action starts to flow, and once the momentum comes into this candlestick, and the sellers start to say, right, okay, we're below the zone, let's get involved, let's place more stop orders, let's place more short orders. The momentum in the high volume periods of this market should take price action to our take profit of at least 1 or 2 hour pretty quickly, and this happens on a daily basis. So again, we'll go through this day by day. I'll be posting my analysis in the room. I'll be going and I'll be putting trade reviews into the room, so you can see this on a daily basis. And of course, we'll be doing live sessions. So take a look at this, maybe watch this video a couple of times, take some notes, and if you have any questions, hit me up in the chat room or send me a DM as usual, and I'll see you in the next video.